The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, joining us now here on Market Talk as we take a look at the market action we've had this week and how things wrapped up on Friday. A few different news headlines to talk about and a few different topics of discussion that I know we'll go down the rabbit hole, so to speak, with Ted Seifried from Zaner Ag Hedge joining us here on Market Talk. Ted, it's always good to talk with you, buddy. How are you?
I'm doing well, Jesse. Thanks for having me. Always good to talk with you too, man.
Friday, we had a fairly okay day in the grains. Let's start there with a little bit of green. Wild markets overnight with the Israeli missile strike in Iran. We largely, pulled back off those overnight highs, though. We got the E15 waiver news out on Friday. I mean, export sales. We got some daily sales. Some supportive things is kind of what I'm getting at here for these markets. Largely, though, just kind of a quiet, okay day to head into the weekend, Ted.
Hey, for soybeans, you had an outside reversal higher day. You made a new recent low, since the contract low back at the end of February, and then, ended up trading above Thursday's high. So from a technical perspective, that's a pretty good sign, but, we got to ask yourself why, right? Mm-hmm. And as you mentioned, we had export sales, or we had some flash sales, right?
Yeah.
But those are mostly new crop, and we are so far behind on our new crop sales that, if anything, that's just a sigh of relief. I don't think that's anything to get terribly excited about. So, what was with the strength there? And it occurs to me, Jesse, that the last couple of weekends, at least, we have had, less of an appetite to go home with big positions than we have previously, and that's all due to global uncertainty, global conflict, Middle East issues, and so on and so forth, right? I mean, look, in the however many years I've been doing this, I lost count now, but I've had to be an amateur meteorologist for the entire time, which is fine, and I actually kind of enjoy weather. But how many other things do we have to do as grain analysts here, Jesse? Like, global trade specialists, trade
political analyst,
political, yeah, now global conflict expert, right? Pandemic, whatever. Here's the thing. I don't think any of us really know what's going to happen. On Thursday, we had the feeling that Israel was going to just maybe wait on anything with Iran and just kind of focus on the task at hand. But then, Thursday night into Friday morning, there's, missiles being lobbed into Iran and Syria as well, and Iraq. And okay. So again, you look at markets and you say, okay, there's a bit less of a risk appetite in this sort of climate. And then you have to look at these individual markets and say, okay, where is the risk? I think traditionally when we talk about risk off, we think that means selling. Because traditionally when we talk about speculators, they're a lot of times long, right? They like to buy. And so when we say risk off, that means they're getting out of short positions. Well, and in the case of the cattle complex, yeah, okay, that's, maybe the case. But in the case of the grains, the risk for them is the big short positions they have. So risk off means short covering, which means higher trade. And we saw that last Friday. We saw it this Friday. The thing is that we gave that all back on Monday morning last time around. Are we going to do that again this time? I don't know. I would suspect probably yes. Which means that, for all the good that we did on a chart there Friday, like I said, outside reversal higher day in soybeans, and then corn, while on Thursday it broke below 440 July, which was a major line in the sand that it really kind of needed to hold. It got a reprieve on Friday and went right back up to its 50-day moving average, which we've been tussling with for 2 months now, Jesse. So, I don't know. But if we give it all back on Monday, does that wipe any positive chart activity off? I don't know. But what I will say is this: uncertainty is probably the best thing that we have for these markets right now. Risk off is probably the best thing that we have for these markets right now, because when you look at the bigger picture, global conflict is not a bullish thing for agricultural commodities, in my opinion. Global conflict and the tie-ins with Middle East and China and these are things that could really muddy the global trade picture. And war is not like it used to be, Jesse. This isn't World War II where we have to feed 19 and 20-year-old men going into battle and things like that. I mean, war nowadays is done with drones and ballistic missiles, things like that. I mean, yes, there is a demand for some commodities, i.e. metals, and also energies, and also energies because of where this is happening. But we don't have to feed armies. So it's not a situation where we're going to have this huge new demand for agriculture, at least not in my opinion. So once the risk off dust settles, I think the risk on portion of this, the realization that none of this is really bullish for agricultural commodities, that's the scarier thing, But if there's an opportunity, like if there is this bigger, broader, short covering event that happens, I think that's going to be an opportunity for the producer, for the American farmer to really, I'd say, get aggressively sold. And it's a big if. I'm not sure that happens. I'm not sure this massive short covering rally happens. But if it does, man, I really feel like we need to take advantage of that. And again, I mean, you're going to hear a lot of analysts say that, war is super inflationary and everything like that. Yeah. I don't know. I have a different view on that. And really, not to go off on a terrible tangent here, but I have a different view, I think, on inflation than I think others do. Inflationary goes in stages. Inflation goes in stages. And what I mean by that is that the beginning stages of inflation happen at a raw commodity level. Now, go back to 2019, 2020, when we're dumping a ton of stimulus into the market. We know there's a lot of purchasing power coming. Companies know that, so they're ramping up. And that means global demand for really everything, raw commodities, really ramps up. And that's exactly what we saw. Now, the second stage of inflation is where that gets passed on to the consumer, i.e. in the form of products, car values going crazy. The box of cereal at the grocery store that was $2.99 is $8.99. Things like that. That happens. So that's the second stage of inflation. And then the third stage of inflation is your service industry, your labor market, because now people have to pay for these higher priced products. And Jesse, I'm here to tell you, we are in the third stage, or the tertiary final stage of inflation. Inflation is sticky. It doesn't go away, but you have to understand how it evolves over time, and you have to understand what that means for the different things that are affected by inflation. And while I will not disagree that inflation is here and still here and possibly getting worse, I don't feel like this is something that is extremely bullish for raw commodities and agricultural commodities in particular. I really do believe that inflation and the past levels of inflation that we've seen is already baked into these markets. In fact, I'm going to say commodity markets, raw commodity markets, are a direct reflection of that first level of inflation. So if anything, it's looking into the past more than into the future. I'm going to say I don't feel like that is a major tailwind for raw commodities. And so I don't like that argument. I hear a lot of people talking about it. Maybe I'm wrong, but I'm not seeing that as a good reason for grains in particular to go sharply higher going forward.
Ted, let's talk about, I know there's been some chatter in the markets too here in the last couple of weeks in terms of NASS getting rid of some of these reports. I know as well, there's also been talk about the big discrepancy between USDA's numbers and Conab's numbers in South America. And you were mentioning this to me while we were off air that you've gotten some clarity on this here this past week. So talk to me about this. I mean, what have you heard? What have you found out? Maybe start with the NASS numbers first, real quick.
Yeah, so I attended the USDA data users meeting in Chicago, which was on Tuesday. I'm super happy we're back to doing this. It's really nice. It's fun to be in basically an auditorium room. It's done at the University of Chicago Glacier. anyways, it's great to be in a room and be able to ask these guys questions, right? They first go over policy changes, which there are some, right? I mean, like you said, getting rid of county level yields and also getting rid of that July cattle report. So they explain that. And then, they open it up to questions for about 2 hours. And so we sit there and just grill the USDA on stuff. It's a lot of fun, actually. Right. But getting rid of the county level yields, a lot of people have a big problem with that, right? My concern with that was, does that dilute the end number that we have at state and national levels? And the answer to that is no, because they're done in different ways. County level yields are surveys, and they're only surveys, whereas state and national are done from actual, they're done more on the commercial side. So from elevator receipts, things like that, right? So no, it doesn't weaken the numbers that we get for state and national numbers. So for me, that was the important concern. But I do understand that for a lot of local, like at grain elevators, they want to know what these county level yields are. I get that. But there's a different way of doing that, and it's RMA data, crop insurance data. It doesn't come when we want it to, and it's a different data set that we've not been using. So there's a transition that has to be made. But honestly, I think that we're going to be better off in the long run because I think it's more accurate data. So I don't know. For me, it's an annoyance, I think, for a lot of people, and it's something that will take some time to transition to and with. And they haven't said for sure whether that might come back for 2025, but we know it's going to be gone for 2024. It's due to budget cuts. I got different numbers from them, from different people in the USDA as for how much it costs to get those county level surveys. Some said 6 million, some said 10 million. Either way, it's an amount of money that they feel is given their tight budget, is given the lack of a farm bill, by the way. They feel like that money is better used elsewhere. So, okay, it is what it is, right? I mean, we can argue about it if we want to, but there's nothing there. It's not going to happen. That's the answer that we got. So, okay. But the bigger one was, look, the big show for me on Tuesday was, okay, we have this huge discrepancy between Conab numbers and the USDA's South American forecast, specifically Brazil, corn, really. But everybody talks about beans. And why? What is going on here? There's always been a difference between USDA and Conab, but it's never been this wide of a margin. What is happening? And I think the best answer that we got from that is that, one, the USDA comes up with their number using a variety of different things, but, really the Above or the Brazilian crush, it's like their NOPA, their crush demand versus their export census, when you put those demand numbers together, there's no way the Conab number, production number, can be accurate. And this has been going on for years, and the USDA's had to go back and revise these numbers higher, because there's no way that they're crushing and exporting more beans than they're producing. Negative carryovers, things like that. It just can't be. And then so when I asked the question, should they have started with a higher number for Brazil, higher than the 163 where they started the Brazilian crop? They said, yes, we absolutely should have. And that is the realization that we've come to over the course of the last few months. While we've had to raise previous years, if last year was a 166, there was no way we should have been starting with a 163 this year. I asked, well, can you share the number that you should have started with? And they say, no, we can't tell you what that is. I said, my number was a 171 as opposed to your 163. What do you think about that? And they smiled and nodded and tight lips. But
sure.
So the fact of the matter, Jesse, is I don't think we should look at the USDA's 155 million metric ton Brazilian production number as they're just being stubborn and they won't lower it more than 8 million metric tons, because honestly, that's not the case. Their starting point in their minds has gone up pretty significantly, I think. So really, instead of it being an 8 million metric ton reduction, you got to look at it more like a 15 or a 16 million metric ton reduction, which is about a 10% reduction, which is a lot more indicative of the weather that they had in Mato Grosso and the issues that they had there. So if you look at it in that light, it makes a whole lot more sense, and it makes that 155 a lot more palatable. Now, I don't think a lot of producers, farmers, and some analysts want to hear that. But I think that's the reality of the situation, and that probably I'm going to say I don't think that 155 is coming down, or at least not by much. So there's that. I also ask, why are the Conab numbers, different, and why is this difference becoming bigger? They don't really know, but I have a bit of a hunch on that. Conab is the USDA, or the Brazilian USDA. USDA is underfunded. Imagine how underfunded Conab is. Their budget is just a fraction, right? And they're pretty good about polling the traditional areas in Brazil. But there's a whole other area in Brazil that, 5, 6, 7 years ago, they tried up in the north to really proliferate that area, because they knew that northern arc, that port system, the biggest deep water grain terminals system in the world, was coming online, and that they wanted to have production as close to that as possible. Is a great idea. But then they had 2 years of really bad weather, yields were terrible, and they kind of shied away or moved away from that northern acreage. And I think the rest of the world just kind of wrote that off as a failed experiment. But I don't think it was. I think they're back, and they are really, really, really doing well. I mean, the weather pattern in the last couple of years has really given them a lot of really good crops up in the north that they are planting. And I don't think Conab has the infrastructure in place to really pull for or account for a lot of that. They're just kind of guessing at it. And I think that's really where the difference comes from. And I think the USDA's now figured that out, and I think has a better idea on it. So for my 2 cents, that's what's going on there. But really, it all kind of adds up to me saying, I don't think you're going to have this day of reckoning that a lot of analysts are touting, saying that, that 155, we're going to we're just going to lose 15 million metric tons of Brazilian production one of these days. And that's going to get translated into a whole lot more U.S. exports, and our balance sheet's going to be a lot tighter, not just for this current marketing year, potentially for next marketing year as well. I just don't see it. And the proof, Jesse, is in the pudding. I know I've been saying this for 6 months now. If this were really the case, if the Brazilian crop was really a 140, you would see China coming in buying new crop soybeans hand over fist. And it's gone the opposite. Really, our new crop bean export sales on the books that we have right now is the lowest that we've had since mid or late 2000s, right? I mean, it's 15 years. It's bad. Yeah. It's really not good. If China, who they've got more people on the ground in Brazil than we do, and probably more people looking at grains in Brazil than Brazil does, for that matter. If they knew that the problem was really that bad, they would be buying from us like crazy, and we would see that, and that would be the proof, and we would be able to say, okay, these stories are true. But without that, Jesse, I think you have to just kind of say, Conab is behind the times. The USDA has caught up and figured it out. I think you got to roll with the USDA number from here on out.
So I think to sum all of that up, as we look at these markets, really, for the U.S. farmer, you got to be a smart risk manager here. We talk about this all the time, but with everything out there, and to the points you just mentioned, you got to protect your risk for your operation at this point, don't you, Ted?
Absolutely. And look, you can listen to all the bullish rhetoric you want, but I think when you're talking about issues in other growing areas, and you're talking about global trade and things like that, just keep watching export sales. And until they tell you not to be bearish, I think you got to stay being bearish. And yes, protect your bottom line, protect the downside. It's more important than ever. Land values are super high, rents are super high. Interest rates are super high. Input costs are super high. These are the most expensive crops we've ever been planting, Jesse. We do not have room to the downside. We have zero tolerance for much lower prices. And by all indications of how the market's trading, what the charts look like, what these export sales are telling us, we could be a long ways from the bottom. So you really do have to protect that and make sure that you can, insulate whatever profit margins you have, right? Or at least draw a line in the sand using like put options or something like that to make sure that you're not very deeply in the red. Because if you are, oh boy, this could be a really big problem with the banks going forward. And unfortunately, I get the feeling that the market's gunning for that, looking for that. Markets always have a mission. And in this case, I feel like they are trying to really put a lot of pressure on the American producer. To maybe see less production. I don't know. That's not worked in the past, and that's a whole other story. I know we've already gone on for quite a while, so we can save that for another time. But I don't know. It really doesn't feel like any sort of bullish news is really being effective for these markets, and that's a bad sign. And again, I'll take it back down to that export sales number. That for me right now is my main indicator of, hey, if the biggest end users in the world, these are very savvy people, if they are worried about prices going higher, they will start buying aggressively. And until that happens, you have to say the smartest buyers in the world are very bearish, and you should probably go with them.
Ted, good stuff as always, buddy. And if real quick, if folks have questions, they want to talk to you about their marketing plan and managing their risk and more, I know they can reach you there at Zaner Ag Hedge very easily. How can they get a hold of you?
Sure. Call me directly, 312-277-0113. You can also find us on the web at www.zaner.com. You can read a bit about us. You can sign up for our afternoon commentary that I do for, I said I was going to do 5 minutes, but it's been stretching from 7 to 10 minutes. I guess I like to ramble, Jesse. Sorry about that. But you can sign up for that, and it gives you access to listen to that. I do it pretty much daily. I didn't do it Tuesday because I was at the data users meeting, things like that. Or, last Friday I was at Market to Market, but I try to do it every day. So feel free to sign up for that. Aside from that, you can find me on the Twitters or the X or whatever, X Twitter, whatever we're calling it. But I am at the Ted Spread.
Ted Seifried, Zaner Ag Hedge. Always a pleasure, buddy. Thanks for joining us. Have a great weekend. We'll talk to you again
Jesse.
real soon.
You too, man. Thanks for having me. Have fun with your weekend, and hopefully you get out and get some golfing done.
I'm going to try. I'm no Tiger Woods by any means, but hey, we'll go hit the little white ball around if we can for sure. Ted Seifried, Zaner Ag Hedge, joining us here on Market Talk. That's going to do it for the show. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@markettalkag and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.